Hello, my friends. Today is July 19th, and this is Markets Weekly. So, this past week, we did make new all time highs in the equity markets, but at the end of the day, it seemed like a very quiet, boring summer week. However, it was the start of earnings week, and we did get some drama about the Federal Reserve. So, today, let's talk about three things. First off, let's have an update on the health of the U.S. economy according to bank earnings reports. And secondly, let's talk about the upcoming potentially two dissents in the July FOMC meeting because Governor Waller has given an impassioned speech on why the Fed should be cutting 25 basis points in July. Let's listen to his arguments. And lastly, it seems like the president is upping pressure on Jerome Powell to either cut rates or quit. So let's think about what could happen over there. All right, starting with the health of the U.S. economy. So as you guys know, I think one of the best ways to understand how the U.S. economy is doing is to listen to bank earnings reports. Everyone has a bank account. Banks make loans to all sorts of companies. So banks have all this data on what the U.S. economy, how the U.S. economy is doing. They can look at transactions, they can look at defaults and so forth. They have their ear to the ground. And so if you listen to bank earnings reports, you can have a pretty good picture on how the U.S. economy is doing. This past week was the earnings report week for the big banks, so let's listen to what they said. Let's start with JP Morgan, the largest bank in the US. So again, as is often the case, JP Morgan was asked about their assessment of the health of the US consumer, and they said, the US consumer, we struggle to find anything wrong with them. Everything seems fine. So JP Morgan thinks everything is okay. What about Bank of America? We're looking at this data from Bank of America. They're saying the same thing, looking at transaction volumes, transaction numbers. Everything seems to be fine. It's not accelerating, it's not decelerating, it's kind of staying where it is, growing modestly. So, that suggests that everything is fine as well. So let's move on to Wells Fargo. Now, Wells Fargo provided us with some pretty interesting data about the credit quality of the loans they made. Now, according to them, loan quality is fine. Actually, it seems to be improving a bit. So the corporate sector, when it comes to credit quality, seems to be totally okay. Now, let's take one look at the American Express data. Now, to be clear, American Express does service a more affluent clientele, but according to their data, looking at the delinquencies in their card business, they're declining. So, basically kind of range bound and definitely not deteriorating. So everything is fine from their end as well. So taking into account all this data, it's very clear that the companies that have the best data on the U.S. economy, on the U.S. consumer, are saying everything is fine. And to corroborate that, this past week, we also had official data on consumer spending, and it printed at a surprising 0.6% month-over-month increase, much higher than any expectations. And so that suggests that, again, the U.S. consumer is totally okay. But do take note, though, that the 0.6% monthly increase in consumer spending is in nominal terms. And because of tariff stuff, prices could have gone up a bit. So in real terms, maybe it's not as rosy. However, the totality very clearly suggests that the U.S. economy at the moment is totally okay. And, not to mention stocks are at all-time highs, right? So why would the Fed even think about cutting rates? Which brings us to our next topic, the upcoming July FOMC dissents. So I think it's been made clear by everyone that Governor Waller and Governor Bowman want rate cuts in July. Everyone else, not so much. And the market understands this, pricing in basically no change in July and just two cuts for this year. Now, I must also note that Waller and Bowman are Trump appointees. However, Governor Waller is making a very principled stance. He is a central banker with a good reputation and has been correct the past few years. And he wrote a long speech explaining to everyone why he thinks it's a good idea to cut rates by 25 basis points this July. So let's listen to what he has to say. Well, first off, he's telling you that the U.S. economy is weakening. It's not super strong. So according to his estimates, GDP growth for the first half is about 1%, and probably going to be around that for the second half as well, which will make the U.S. grow at below potential. Now recall, first quarter GDP growth was negative. Second quarter, we don't have the numbers yet, but according to the Atlanta GDP nowcast, it's estimated to be about 2%. So while there's 1% growth for the first half, not unreasonable. And he's suggesting further weakness for the second half based on his estimates and also looking at softer qualitative data. So one of the things he's looking at is the Fed's Beige Book, which is the Fed's intelligence collection program where they go out and they talk to businesses throughout the country and compile what businesses are saying about their current circumstances. And according to the latest Beige Book, a lot of companies are saying that growth is moderating or weakening. So things look like they're slowing down. Now, Waller also points to consumer spending data to show that, consumer spending just isn't strong. Now, we did have that strong number last month that we talked about, but if you zoom out, you also notice that in the past few months, we've also had a few negative numbers as well. So when you average them all out, consumer spending for the first half of this year doesn't look that strong. So the backdrop is the U.S. economy is slowing and going to grow below potential this year. Now, the Fed's mandate, of course, is full employment and price stability. So what does Waller say about full employment? Now, according to him, the labor market is not as strong as it appears to be. So last month, we did have a good jobs report. Unemployment rate is at 4.1%, and we had a much stronger than expected job creation number. However, as we discussed last time, a lot of those jobs were basically public sector jobs, like school teachers and so forth. When you look at private sector employment growth, it's actually down a lot. It was only 70,000. And Waller thinks that, maybe part of the reason you showed such strong public sector job growth was just due to adjustments in the data, seasonal adjustments that are difficult to manage sometimes. Now, he also points out that if you look at the unemployment rate for new grads, it's been trending higher. So new grads are having a harder and harder time finding jobs. So also, of course, we also note that in the past, job growth has often been revised lower. In fact, if you look at all the revisions, it's possible that we didn't really create any private sector jobs for the first few months. So the job market, according to Waller, is on thin ice. It's something that we should be cautious about. Okay, if labor market is slowing, what about inflation? Now, the big wild card for inflation has been tariffs. And you see many people on the FOMC saying that, we can't cut rates because tariffs are going to put inflation higher. And so we got to be mindful of that. Now, Waller is not concerned about that because according to standard economic theory, tariffs have a one-time increase in the price level, but don't impact inflation. So what does that mean? So let's say that you have a tariff, 50% tariff. Let's say that gets passed on to the consumer, and that means prices for that good go up. But next year, though, that 50% tariff doesn't become any higher, right? At least I don't think anyone expects it to go even higher. So next year, prices don't increase by that same level, same amount, same percentage, or maybe don't even increase at all. It's a kind of a one-time upward shift in the price level rather than a change in the rate of change, which is what inflation is. And this is super consensus, standard macroeconomics, standard central banking talk, and Jay Powell used to think this way as well. So from Waller's perspective, having these tariffs really should impact how the central bank views inflation. The central bank should look through it. However, he also notes that through his conversations, he's talking to a lot of businesses and so forth, he thinks that about a third of the tariffs will be absorbed by the exporter, a third by the business, and a third by the consumer. So even if these tariffs stay on, the consumers will only bear a fraction of it. And at the end of the day, it's only going to have a temporary increase in PCE. And according to his studies, looking at where PCE is today, if you strip out the tariff effects, we're basically already at 2%. And To add on to that, Waller also notes that inflation expectations, as he views them, are totally stable. And he seems to place more weight on market measures of inflation expectations. So, for example, the five-year inflation swaps, basically an estimate of what 5-year inflation will be 5 years from today. When you look at where the market is trading this, you'll notice that the market is not worried about, high inflation at all. It's basically been that five-year inflation has basically been where it's been for the past few years. It's kind of range bound. So if tariffs are just going to be, transitory and maybe not fully passed through, and inflation expectations are stable, the Fed really shouldn't be worrying about inflation. So from his perspective, labor market is weakening, inflation is okay. Now, the last piece of his puzzle is the stance of monetary policy. So when the Fed makes a decision, hike rates or lower rates, it has to have a reference point. And this reference point is commonly called the neutral rate. So basically, if interest rates are above neutral, you're being restrictive, you're slowing the economy down. And if interest rates are below neutral, you are easing, so you're trying to speed the economy up. Now, according to Waller, he's like, people on the FOMC, they think that the neutral rate is about 3%. And right now, say we're like, 125, 150 basis points above that. So that doesn't make sense. We should be much closer to neutral because, after all, labor market is slowing, growth is slowing, and inflation is basically at target. So it doesn't make sense for us to be so restrictive. So that is his argument, and I think this is totally reasonable. There are many people who think this way. Now, there are others who will say that Governor Waller is just saying this because he wants to be Fed chair. He actually gave an interview, and let's hear what he said.
You've been nominated by this president for the seat on the board.
Yes.
You were previously director of research for Jim Bullard way back then. Is it a position you would like? Is it something you would like to do in the future?
Look, in 2019, the president contacted me and said, would you serve? And I said yes. If the president contacted me and said, I want you to serve, I would do it. But he's not contacting me.
And we'll see if he does.
If he says, Chris, I want you to do the job, I'll say yes. But he's not talking to me, so that's it.
So yes, of course he would like to be a Fed chair. Who wouldn't want to be a Fed chair? But I think what's also insightful is that he made his pitch in that interview why it should be him.
I mean, at the end of the day, the president, whoever they choose, you're going to have somebody that has credibility with the markets, or you will see, as Jonathan was just talking about, you're going to see inflation expectations spike. You will not get lower interest rates. You will get higher interest rates. This is well known. We've seen this everywhere around the world when this happens. And I know Scott Besson knows this. So this is not something that is lost on anybody.
So he's saying that, you hire one of your yes men to be Fed chair, markets will revolt. But, markets trust me. And that's a good pitch. And as far as I hear, though, Waller does not have a strong relationship with Team Trump. So not impossible, but at the moment, not super likely, although I think he would be a good Fed chair. Which kind of moves us to our last topic. So the president is very much putting the pressure on JP, calling him too late and really trying to run him out of the Fed. Now, this past week, there was kind of a surprise headline where it seemed reporting suggests that Trump was going to fire Powell imminently. He had this letter that he was showing to lawmakers saying that, this is this letter to fire Jay Powell. What do you guys think? And this is actually pretty classic of Trump to do that. Trump, when he wants to do something, he talks to a lot of people. He really wants to have a lot of input to make sure that, make a good decision. And I think in part it's also to kind of socialize this potential action to people so that they won't get super freaked out. Now, the market totally freaked out at this headline, and you had a classic capital flight move where you had the dollar sell-off, equity sell-off, and bond yield spike. So I don't know if this will happen, but if this were to happen, if Chair Powell would be fired by Trump, it would be a market negative event. Don't doubt it. So the president's allies have also joined in, and it seems like they're building a case to try to get rid of Powell on the grounds that Powell is mismanaging the Fed. So Director Vaughn in the White House sent a letter to Jerome Powell and highlighted here saying that you're not doing a good job, and the reason is that Chair Powell was spending a lot of money renovating the Fed building, spending too much money, not doing a good job, and maybe using that as a reason to push him out. And you also have a lot of pressure from FHFA Director Pulte, who's kind of been spearheading this effort. I think he was the one who wrote that letter that President Trump was showing around. Director Pulte, of course, cares a lot about housing affordability. He is director of FHFA, and also, of course, he is heir to Pulte Homes, which is one of the largest home builders in the U.S. Now, monetary policy, to be fair, is clearly restrictive when it comes to things like housing. So, for example, house prices nationally look like they're declining, and if you look at housing starts, they've also declined as well. So, even though the stock market is at all-time highs, industries that are very clearly interest rate sensitive have not been doing well. And that seems to be what the president is thinking about. The president obviously has a strong background in real estate, and in the real estate segment, they're interest rate sensitive, especially if you're commercial, because a lot of commercial loans are for a few years, and then you roll it, and a lot of the loans taken out at very low interest rates a few years ago, today, if they were to be renewed, are going to be several hundred basis points higher. So from what I understand, there is some real stress in certain segments of the commercial real estate market, like multifamily apartment buildings and stuff like that. So that could be what's driving the president to try to cut rates. At the moment, I think that people don't think that this will happen, but it's always hard to say. It's very clear that there's a team of people in the White House who have prepared Plan B, whereas they can go with this removing Chair Powell for cause on the basis of this renovation stuff, should the president decide to do so. I'm sure there's also many smart people in the White House telling the president that this will be bad for the markets, which the president acknowledges. At the moment, as I understand, Secretary Bessent is actually far away in Tokyo, so he's not able to offer advice on this, but it's something to keep in mind. Now, I think, though, my best guess is that if this were to happen, it'd probably happen after Trump has that idea of who the next Fed chair would be, so that there wouldn't be some kind of vacuum. If Chair Powell were removed, I think the chairmanship would move to Vice Chair Jefferson through I think that's the procedure, but ultimately naming the president's next potential Fed chair, I think would give the market clarity and I think a bit more stability. So don't know if this will happen. President is having a bad news cycle with all these talk about Epstein and so forth. So we'll see what he does. I think it's unlikely, but not impossible. All right, so that's all I prepared for today. Thanks so much for tuning in. Talk to you all next week.